Hello and welcome to Crypto Weeklies. In this video, we are going to analyze Dogecoin and its token Doge. None of the content is financial advice. Let's get started. Over the last 24 hours or so, Doge has rallied by a lot, about 12.5%. Market cap at around $34 billion, volume at around 2.3 billion, circulating supply at around 150 billion Doge. Um, has had a 7-day rally of about 30%, 30-day rally of about 50%. If you go to the go to the Crypto Weeklies chart, again you can see there are some Aptos has rallied slightly more than Doge, but over the last 7 days you can see ETH has taken the center stage now, at around 35% up over the last 7 days. Doge is also up, but again there are other names such as Uni and ETH rallying more than Doge. Nonetheless, Doge at number 3 spot over the last 24 hour, number 2 spot over the last 30 days. There are some names rallying such as Sui, BitTensor, Stacks. They rallied a lot over the last 30 days. Again, ETH is also up by about 55%. And also Doge is somewhere over here at around 41% rally over the last 30 days. Or the last 90 days, again several cryptos are still down. If you compare the last 90 days, again leader is Maker, and then XMR and Bitcoin Cash. Overall, Maker has had the most rally over the last 90 days. So coming back to Doge, this is our machine learning based price forecast for Doge right now. Price of Doge is coming in at around a key level at around 22 cents. The price has not seen this level since about two and a half months ago, since the March 2025, early March 2025 crash in the crypto market began. Again, there was a kind of a U-shaped recovery that Doge has had over the last 2 months or so. Now the price is at a critical juncture, the 20-week simple moving average coming in at around 23 cents. If the prices rally beyond that level, again that could kickstart a bull market, or if there is a fake out and then again a retest of 20-week and then a rally like it did back in September 2024. Again, the other scenario for Doge is the bear case is that the 20-week simple moving average acts as a resistance, and the price kind of does a double bottom at these levels, and then the recovery begins. So those are the two possible scenarios per the technical analysis and the interpretation of chart. Again, these assets are highly correlated, so what Doge does depend on what Bitcoin does. Again, that is Bitcoin is the leader of that asset class. If you look at Bitcoin's rally over here, price is kind of consolidating at around 103k. So let's see if Doge and Bitcoin both have the bullish momentum that they need in this post-halving year. So in terms of the price forecast with respect to the machine learning model, the price of Doge is kind of at a key level. In the next 6 months, if the prices were to have a non-euphoria bull rally, the prices could be somewhere between 22 cents per this model and about 59 cents. This model is trained on weekly price action since Doge kind of came around in the November 2017 rally. The directionality again for Doge is again this pink line, which says all things equal, the likelihood of price growing up with time is higher than price going down with time. That is because Doge tends to have this major rally, then 3 to 4 years of consolidation, finding that bottom, testing it several times, and then in the next post-halving year taking one further leg up, and then from 2021 doing the same thing again, trying to carve out a bottom, then series of higher lows and higher highs. This time around slightly different than 2018 and 2019, where there was a lower low at a weekly average time period since about March 2020. This time around there has been a series of higher highs and higher low. All these directionality related cases point to that higher highs and higher lows. In terms of the bear market, if there is a bearish phase in the market, in the next 6 months the price could find support between 9 cents and about 17 cents. So the purpose of this models is to identify what the prices could do if there is a bull case, bear case, or the base case. Again, there is no crystal ball which can say that prices have to go up or down. Again, there are favorable seasonality such as in the post halving year, where the prices for alts do go up, at least using 2017 and 2021 as an example for Doge. So the two standard deviation or the Euphoria case for Doge takes the 95 percentile confidence level, saying that the prices could be between this orange line, between 25 cents and $1.31 if there is a continued bullish momentum in the market. A $1.31 Doge with outstanding or total circulating supply at around 150 billion takes the market cap again at around close to 200 billion again. That is quite outlandish, but again, that's what just a model says. Again, the purpose of this model is not to provide any financial advice, but just an interpretation in case of there are multiple outcomes that are possible. Again, taking an average of those two scenarios, personally speaking, makes the most amount of sense. 60 cents and $1.30 again, adding them together, $1.90 dividing by 2 at around 90 to 95 cents. That becomes slightly more realistic as an interpretation of the model. In terms of the regression based fair value estimation for Doge, this polynomial regression pink line helps identify what is the fair value in a non-linear fashion. That is, during the bear market, the fair value does go down with time. In the bull market, goes up with time. That is because any fluctuations that occur in the bull market offer asymmetric returns. Similarly, in the bear market, again during the accumulation phases, a dynamic DCA strategy towards the bottom does make the most amount of sense. That is the interpretation of these models. And as the bottom is carved out, that is where the accumulation phase kind of begins, like it did back in early September 2022 till about December 2023. Now the fair value of Doge is coming in at around 35 cents. If we were to apply one standard deviation residual to the upside, this yellow line helps identify what could be a theoretical series of resistances which the price action has to contend with before the start of the euphoria phase. So this yellow line can, for the interpretation of model, can and does get breached only during the peak euphoria phases of the market cycle, like they lasted in about May 2021, where at times not just the two standard deviation band, the orange band, but also the red band, the three standard deviation band gets challenged and the rally continues beyond the two standard deviation. But right now, again, with diminishing returns and cycle to cycle price action and market cap related tokenomics related interpretation, the two standard deviation ceiling coming in at around $1.90 and the one standard deviation ceiling coming in at around 81 cents, together averaged come at around $1.30. Again, that is the machine learning based price forecast as well. That is the realistic ceiling per the interpretation of the models. On the other hand, if the prices again stay undervalued, and interpreting how they are closer to the bottom is identified by this bottom regression green line, which is the lower band one over here. That is one standard deviation residual applied to the downside of the fair value, accumulating close to the green line. Again, as an interpretation of the model, definitely not the worst idea. Again, the distance of this price versus this fair value estimation is captured by a DCA model that we have over here. All of the content, by the way, available for free on cryptoweeklies.com. You don't have to pay, sign up, or watch any ads over here. If you like, just give a like and subscribe. This is the same model that we were discussing, the fair value, and based on the discussion, based on the distance between the fair value and the price, the risk levels are calculated, and again accumulating closer to the fair value for Doge, especially with that behavior that Doge has had, making a major move, then consolidating for 3 to 4 years, and again repeating the same process again, using that kind of lens where DCA just at levels where the risk is per this model, personally speaking, whenever the risk is less than 10%, made the most amount of sense. Right now the fair value coming in at 35 cents. If the prices were to go anywhere close to that dotted red line, that ceiling is at around $1.57. If we were to be slightly more conservative and try to estimate what could be some of the non-euphoria target for Doge, again euphoria phase for Doge is too far between. So these phases of the price action are captured by the 0.1 to 0.3 risk level. If the prices were to go to that 0.1 to 0.3 or 10 to 30% risk, the prices per this model go somewhere between 33 cents and about 70 cents. So this is the target, per more realistic target for Doge, between 33 cents and 70 cents without any major euphoria in the market. So that still leaves the gain somewhere between 3 and 3.5x with the current price of Doge at around 23 cents. So let's try to interpret the model using the simple moving average or the 20-week simple moving average based analysis. Again, this model uses 20-week simple moving average to color code the risk level. Again, a similar insight with this model is that, again, right now the risk is coming somewhere between 10 to 20%, slightly elevated compared to the regression model, which says less than 10% risk. Now it's, for this SMA model, it's 14% risk. It's always good idea to have multiple models and try to drive confluence between those models. Again, this model does not do a great job of identifying the actual accumulation phase, but it does identify the risk levels where the price has come down significantly to help assist in any dip buying. Right now, this model did identify an accumulation phase from February 2025 till about early May 2025. So right now risk levels at around less than 20%. Still, if they were to go to that intermediate risk territory for Doge that we highlighted, between 20% risk and about, let's say, 50% risk, that's the territory of most importance, between 0.2 and 0.5 risk. If the prices were to go to that level per this model, price could be between 36 cents and above 54 cents. So that's the non-euphoria forecast. If you were to account for some euphoria, the target could be between 40% and let's say 60 to 70%. That's the above 60% risk. Again, that's where the blow off top scenarios kind of pan out. There are no guarantees that there are always going to be a blow off top scenario. So realistically speaking, between 40% and 70% risk, or 0.4 to 0.7 risk, again, per this model, that valuation for Doge could be between 48 cents and about 68 cents. So that's the area of confluence with that 70 cents target that we talked about across multiple models. The last but not the least is the time weighted average price, which helps identify a great accumulation phase during the bear market, essentially, where the price of Doge whenever is close enough or slightly lower than this blue line, which represents the time weighted average price, how much time has a price spent at any given price, and driving that average based on the time spent at those key levels help identify what price can Doge realistically digest, and above going below that digested price becomes more and more unlikely. You can see in the last bear market of 2018 to about 2020, prices did spend a lot of time below the time weighted average price. Again, this kind of analysis holds true only when the underlying asset has some significant utility or significant presence in the market. Doge, being one of the top 20 cryptos for a while now, does justify that claim. Again, at least that is my interpretation of these time weighted average price model. Right now the time weighted average price risk is slightly elevated, again 64% as opposed to the other risks close to 10 to 20%. If you were to tune out any noise between of any individual crypto, again, or an individual model affecting the overall risk, this overall risk reward based estimation says that there is a 3% regression risk, 60% time weighted average price risk, 11 to 14% simple moving average price based risk. So overall the weighted risk is at around 22%. This is not equally weighted. Regression risk takes precedence over here. That is because that is a better indicator, at least during the experimentation phases. Again, all of the models took about thousands of hours of effort to develop. Lot of statistics and data science going behind them. So if you like, please give us a subscribe to stay updated and help grow the community. So the Doge's overall weighted risk at 22% or 0.22, estimated bull run peak comes at slightly under $1 with a reward of about 4.3 3x from the current price of about 23%. Again, the consideration we took over here is all of the models cannot realistically have 100% risk or 0.1 risk at one point. So this model at weighted at a bull run peak estimates that there is only 95% of that weighted risk at the blow off top phase. If you want to be slightly more conservative, taking a 60 to 80% of this bull run peak does not hurt. That again, 60% of a dollar is 60 cents, 80% of a dollar is 80 cents. So that is a more realistic scenario, and averaging those out comes at exactly at around 70 cents. That is one of the areas of major confluence for Doge. And with that, I would like to conclude the video. Hope you enjoyed the content. If you did, please give us a like and subscribe, and hope to see you again tomorrow. Thank you and have a nice day. Bye bye.